Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
That's right. It's the U.S. Market Update, and I am Emaad Akhtar. U.S. stocks roared back on Monday after the U.S. and China agreed to temporarily slash tariffs following negotiations over the weekend in Switzerland, raising hopes that a trade war won't push the economy into a recession. A quick recap of the numbers. The Dow Jones Industrial Average surged 1,161 points, or about 2.8% to close at 42,410. The 30 stock index ended the season near its highs of the day, with buying enthusiasm remaining strong. The S&P 500 popped 3.3% almost to end at 5844, bringing its gain since April intraday low at the height of tariff pessimism to more than 20%, would you believe it? The benchmark has cut its year-to-date losses to just 0.6%. And finally, the Nasdaq Composite added 4.4% and settled at 18,708 as the initial China agreement sent tech stocks tied to the country, such as Tesla and Apple, flying higher. It was the best day since April the 9th for all three indexes. And to break it down for us, we've got with us on the line Ryan Detrick, Chief Market Strategist from the Carson Group. Ryan, welcome back to the show.
Good morning, and thank you for having me back. I appreciate it.
Yeah, you're more than welcome. It's a good time to have you back because markets seem to be rallying after the news of the recent U.S.-China tariff cuts. I think most investors will be scrubbing their eyes to make sure they're not woken up from a dream here. They came in much larger than expected. Your initial thoughts?
Yeah, you're right. I mean, just on Friday, President Trump kind of floated the idea of maybe dropping the tariffs to 80%. And then we come in, and they're only 10%. Now, there is the 20% extra for fentanyl, but nonetheless, this is way lower than anyone expected. Honest to goodness, a week ago, I don't think too many people even expected this to take place this soon. But here we are, and that's why, like you just mentioned, stocks, at least in the U.S., had their best day since April 9th. The S&P 500 is virtually flat on a total return basis, less than 5% away from an all-time high. Last comment here, we were down 18.9% off the highs as of April 18th, nearly in the bear market. What a incredible run it's been, or ride it's been the past 2 months for investors. We went down, but now we're getting the other side of it, and now we're getting the upside.
Yeah, just to recap, so the U.S. will effectively cut tariffs on imports from China to 30 from 145%, while China will reduce tariffs on U.S. goods to 10% from 125%. That's effective from the 14th of May for 90 days. What it's done for members of the Magnificent Seven is added an aggregate of $838 billion US dollars, Ryan, in market value. This is the largest collective move for the group since the 9th of April. What does this mean for tech stocks like semiconductor firms and smartphone makers, which have been hit hard by these trade tensions?
Yeah, I like to use the example. You take a beach ball and you put it way under the water. Once you let go of it and it gets moving, it gets a lot of momentum, and it can go a lot further and a lot higher than you probably expect. And that's what we've seen, right? Those were the most beaten up groups.
Yep.
Rightfully so. I mean, those Mag 7 names, semiconductors, they're the best groups the last couple of years. So we had a very, very rough start to clearly 2025 for some of these reasons. So this is just another positive development. Year to date, as of right now, the top group in the United States is actually industrials. The second best group is financials. I mean, to see industrials or financials leading, that's not the market's way of saying, oh my, there's a big, recession on the horizon or trouble. Those are groups you want to see leading, but to see technology and some of those other previous laggards bouncing back, it's just a sign, again, I know it sounds crazy, but a relatively healthy market with a lot of broad-based participation. That's what we want to see.
Yeah, indeed. You talk about signs. Let's see what this means for the Fed moving forward. Now, they recently decided to hold rates at their, most recent May meeting, FOMC meeting. That didn't surprise many, but they seem to have gotten one more reason to wait on cutting rates after this delay in the imposition of tariffs on China, because it reduces the chance of a potential U.S. economic slowdown that would have forced the Fed to rush to the rescue by reducing borrowing costs. What are your thoughts on that?
No, you're right. And one of the things, I guess, I don't surprise investors is the way to put it, but we saw yields go higher today in the U.S. by a little bit because stocks did so well. And gold was down, I think, close to 3%, at least in U.S. trading. So money rushed to stocks. But the reality, the Fed has said, hey, listen, we probably would have been cutting rates, but because of all these tariffs and the uncertainty with tariffs and the higher price of tariffs, we're on hold. And you're right. I mean, listen, the odds of a recession after today's news have gone lower. That's why the stock market is soaring like it is. I think we're still optimistic, though. We're going to get some Fed cuts here. It might not be in June. It might be the meeting after that. But again, when you look at wages, last comment here, look at wages in the U.S., they're like a little bit over 3%, and they're kind of trickling lower. You do not need short-term interest rates, in our opinion, up around 4.5%, where the Fed has things now. But again, it's all about the worry over potential future inflation. We're not so sure that's going to be the same worry now with these tariffs hopefully starting to work their way into some better news. But the reality again is there's probably some cuts coming. It's just still going to be a little bit longer maybe anyone would prefer, but it's just the world we're living in. But hey, at least stocks have come back.
Yeah, speaking of better news, Ryan, you've said that the lows are likely in for the year. What's giving you that confidence, especially with talk of an economic slowdown still on the horizon, despite the positive news that we've been hearing?
Yeah, and we've actually been saying that here at the Carson Group for a while, a while as in 2 or 3 weeks. And I know it's like, oh, you say it now, you're almost 20% off the lows, but we have been saying it. There's a few things to look at. One I want to focus on. We had a near bear market, as we all know, down 19% or so on the S&P just this time on April 8th, just about a month ago. We've corrected, or retraced is better, or recovered. Let's go with the word recovered. We've recovered more than half of that bear market. I found 16 other times at a near bear market or bear market, and then we recovered half of that. Only once did the S&P go make new lows. That was actually in 2022, just the most recent time. But look at all those 16 times, 1 year later, stock market was higher every single time a year later. So there's a lot of other indicators, but to me, that's one that just triggered, and that's an encouraging sign. One more, I believe today, the New York Stock Exchange advanced decline line. That's a cumulative basis, how many stocks going up versus down. Think of it like market breadth. If a lot of stocks going up, these advanced decline lines are strong. That hit an all-time high today. Breadth leads price is how I learned it a long time ago. To be seeing market breadth, advanced decline lines hitting all-time highs is likely a sign that the overall stock markets, S&P 500, NYSE, the Dow, a lot of them, I know it sounds crazy when you look at the headlines, but they likely will be hitting new all-time highs sometime later this year as well, which honestly isn't all that far away in a lot of cases.
Yeah, it's not. It's not very far away at all. Another positive indicator, or just an indicator in general of the health of the U.S. economy, is the earnings season, and it seems like it's turned out better than expected. Were there specific sectors or companies that helped change the tone, in your opinion?
Yeah, back to that Mag 7 we were talking about. I mean, the Mag 7, and others, the Tesla didn't do all that great, but boy, oh boy, just about every other one of them had some really, really positive things to say, with the M&Ms, Meta, and Microsoft really strong. I mean, that was technology. Big cap tech did really well, but just broadly speaking, on, let's say, I guess it was March 31st, S&P 500 earnings were expected to be up approximately 6.5% in this first quarter. As of Friday, when we got some final data, and most companies have reported, you're looking at up almost 13.5%. So you're talking almost double, like virtually double. I mean, earnings have come in way better, and we get it. It's what have you done for me lately? What about the guidance? And guidance has been murky at best. But overall, the incredible amount of fear and worry that we were seeing and feeling this time 4 or 5 weeks ago, it did materialize. I mean, yes, because we've got better news on trade. That's why the stock market, at least in the U.S., has done so well. But I think a lot of also earnings seasons come in way better. And other comment on this, the consumer, they're not spectacular in the U.S. They're still pretty solid overall. We'd say slowing but not cracking is how we would explain the U.S. economy. And we look at initial jobless claims, last comment on this one, initial jobless claims are still very low based on history. So we're not seeing layoffs. We're not seeing initial jobless claims. Again, some cracks, yes, but by no means looking like a recession. And when you put all that together, that's why I believe today, at least from the intraday lows on April 8th, I think we're up almost 20% on the S&P 500. That's why we've had such a spectacular rally the last 5 weeks.
Yeah. You've also pointed out, Ryan, that the worst and best market days tend to cluster. So the question is, how can investors avoid getting spooked by the lows and missing the bounce?
Oh, boy. I've done this for 25 years, and this is the ultimate question. And trust me, I guess just knowing history, right? If you look at history, that's what you just mentioned there. If you see the biggest down days of the year, they tend to nearly always take place right around the biggest up days, because normally what happens, just like we just saw, we had a 10% drop in 2 days, the 2 days after Liberation Day on April 2nd here in the U.S., and sure enough, that following Wednesday, we had a 1 day 9.5% bounce. That's how this works. And you can extrapolate it out. Monthly returns, right? The S&P's up 13% over the past month off those April 8th lows. It was down 12% for the month as of April 8th. So it's not a shock that we had a horrible month, and then a month later, you're having one of the best monthly returns ever. So it's just important for investors to remember volatility is the toll we pay to invest. We like to say that around the Carson Investment Research team. If you can't stomach volatility, then longer-term investing might not be the thing for you. But hopefully most people learn that every year is scary, every year is volatility, every year is bad headlines. We're going to get through it just like we've gotten through all of them before, and that's kind of what happened. Unfortunately, a lot of investors panicked and sold, April 8th, April 6th, April 7th, after Liberation Day, and then they look up, and my goodness gracious, stock market's up huge. That's what we've seen throughout history, but hopefully a lot of listeners out there to this show and a lot of other long-term investors realize that's just part of it. Volatility is the toll we pay to invest.
Excellent way to end this interview, Ryan. It's been a pleasure having you on the show. Thank you so much once again for your time and insights.
Anytime. I appreciate it. Thank you for having me back.
All right. Have a good week. That was Ryan Detrick, Chief Market Strategist at the Carson Group. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.